Morning, guys. It's Wednesday, September 3rd, 5:25 a.m. Central Time. Grain markets are mixed this morning, fairly quiet overnight trade. December corn futures down 1 at 4.22. November soybeans up a quarter cent at 10.41 and a quarter. December Chicago wheat down a half cent at 5.27 and three quarters. December Kansas City wheat up 3/4 of a cent at 5.12. December spring wheat down 1.5 at 5.72 and three quarters. The Wall Street Journal had a big write-up on corn and soybeans this week. Let's start there.
So, advances in technology and government policies promoting higher production have created an oversupply of both crops. Although farmers harvested 2% fewer acres in 2024 compared to 1924, they produced 729% more corn. This surge in production has pushed prices lower and eroded profitability. U.S. farmers had long relied on expanding global demand, but trade disputes, tariffs, and shifting policies have restricted access to key international markets. Meanwhile, Brazil has surpassed the U.S. as the world's leading exporter of corn and soybeans, supported by abundant farmland and modern infrastructure.
This was printed in the Wall Street Journal, which means that it was widely read, and that's why we're talking about it today. They did this as kind of like a visual presentation. I liked some of their charts. I didn't like some of their charts, and some of their copy was not great. As an example, you mentioned there, and this was in the article, Brazil has surpassed the U.S. as the world's leading exporter of corn and soybeans. I think there's been 1 year of the last 10 that Brazil exported more corn than the U.S. The U.S. is still the top corn exporter. Let's run through some of the charts here. So they've got this farm cost versus price received. And looking at this chart, it would indicate that farmers lose money every single year, except for 2012 and like 2006 or 7. And that's not true. Farmers made money, generally speaking. 21, 22 were pretty good years. There were some decent years in that 2007 through 2013 timeframe. So this is not necessarily reflective of the reality that I'm familiar with. Chris Barron has some really good charts about this. There was one example in here about a North Dakota farmer who farms 8,000 acres. They said he lost $400,000 last year. He's relying on getting about $200,000 back as part of Congress's $10 billion farmer bailout that was passed in December. That's ECAP. A lot of those checks have already gone out, not the full amounts, but most of it. This year could be more of the same. And they're talking about how I think they kind of imply that maybe there's some more government payments. The farmer said this: we don't like to get government handouts, but we don't like to go broke either. It's a tough time in row crop production. I think that's a prevailing attitude among farmers right now. Like, we don't like the government handouts, but we don't want to go broke. You know, it's we're in a tough situation. Here is the next chart. And I am not very smart, so I had a tough time reading this at first. So you look at that little dot that says 1850 kind of in the center toward the bottom. And at that time, farms were small and there were not very many farms. And then by, I think it's 1935, that's when we had the most farms in this country, 6.8 million. And the average per acre farm was like 155 acres. And it's been nothing but consolidation in the farm space since 1935. We went from 155 acres on average to 460 acres on average, and basically declined every single year up until maybe 10 years ago. And now the consolidation is actually slowed just a little bit. It's kind of flatlined just slightly, but I think it still is. The big farms are getting bigger. The small farms are going away. Long story short, they talk about production efficiency. We always hear the argument, Mackenzie, have you ever heard this? People will be like, corn has not adjusted for inflation. You know, it's the same price as it was 40 years ago, and corn should be $15 a bushel. The one thing that people fail to take into account, that the one flaw in that argument, is that production efficiency is improved monumentally. Like in 1980, I think the average national corn yield was like 100 bushels an acre. And now we're talking, 180 plus this year. That doesn't totally render the inflation argument irrelevant, but it renders part of it irrelevant. I will say that the post-COVID inflation that we've seen, CPI is up 30% since the pre-COVID timeframe. The corn market, of course, has not adjusted to that at all, while all the inputs have adjusted. So there is an argument to be made there. They had some kind of flow charts in terms of where everything goes. Where does corn go? Where does soybean goes? We know that. And then the export charts is really good. The soybean one in particular, we've had versions of this. Ours are better, but theirs are okay. Brazilian soybean exports are phenomenal and just continue to move up and up and up. And we basically flatlined. Corn exports, the U.S. is still, as I mentioned, number one, but Brazil is kind of creeping up here. One thing that I'll mention to you guys about all of this is very much like a doomsday article. and you guys know this, but it doesn't feel like it right now, but you know this. This stuff is cyclical. It was just about 3 years ago that The Economist printed this, the coming food catastrophe, and they had the wheat with the little skulls on it because we were going to all starve because of the Russia-Ukraine war. It's only 3 years ago that corn was like $6 or $7 and wheat went into the teens and beans were in the teens. It wasn't that long ago. I know it's hard to remember that in this sort of environment right now, but this stuff goes back and forth, and it goes back and forth very, very often. It feels especially bad this time because production costs are so high, but it is cyclical, and it will cycle back the other way. And this article is just one of these, like, it's a doom and gloom article because things are doom and gloom right now, but it was the exact opposite just about 3 years ago.
U.S. farmer sentiment declined for the third straight month in August. Purdue University's CME Group Ag Economy Barometer Index fell to 125 last month, a 10-point decline from July. A more pessimistic outlook drove the decline, with the index of future expectations falling to 123, its lowest level since September of last year. The current conditions index inched up 2 points to 129. Loan concerns grew last month, with 22% of respondents expecting their loan size to rise in 2026. That's up from 18% in January. Among those anticipating an increase, 23% cited the need to carry over unpaid operating debt from 2025 into 2026. 50% pointed to higher input costs, and 28% attributed the loan size increase to farm expansion.
I still every month fail to comprehend this index. I need somebody to explain it to me, because right now the index of optimism supposedly is better than it was in 21 and 22 when corn prices were like in the $6 to $7 range. I don't necessarily understand that. There were a couple of interesting charts here though. Compared to last year, do you expect the size of your farm's operating loan to be larger, smaller, or about the same this year? And pretty much everybody on the same page. It's going to be, about the same, some larger, but production costs remain high versus last year. Here's the other thing. If your production or your loan is increasing, what's the reason for your farm's larger operating loan? And it's inputs. I mean, input costs are phenomenally high, and we don't talk about inputs enough because, they don't necessarily change every day like the market does. And there's not as much information or things that we could talk about as it relates to inputs, but the sky high input costs, whether it's cash rent, fertilizer, seed, implements, that's the big problem right now. Low prices are a problem, but the sky high input costs are certainly maybe the bigger problem.
If you guys haven't checked out our premium content, you sure need to do so. Joe, can you tell our viewers about yesterday's premium video?
Speaking of sky high inputs, Josh Linville, fertilizer expert from StoneX, was on yesterday, and we did a fertilizer mailbag. Our premium subs sent in questions for Josh, and he answered them and laid out essentially the entire scenario. What's going on fertilizer? Why are prices high? Are they coming down? Should I lock this stuff in? We had, 20 questions that came in from subscribers, a 25-minute video. Really, really fantastic stuff. There are not very many people who understand fertilizer pricing and dynamics, but Josh does, and he does an excellent job. That video was available yesterday. Brian Splitt's going to be on today doing charts, and I'll tell you what, we're not covering it in the show today, but the corn chart looks very, very interesting to me, to say the least, and I assume that he will cover that. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. There's no other fee, no other obligation. Nobody tried to sell you anything else. We just want to blast you out our content every single business day. We have 2 emails per day. The Standard Grain Morning Update is jam-packed full of headlines, graphics, cash grain marketing info, charts, everything you need. All of our recent premium videos. That goes out at 5 a.m. Central Time. So that thing's out super early. I'm up early putting it together every day. I'm up at 3:45. I start putting that thing together, and it's out by 5. And then the premium video for that day goes out at 10 a.m. Central Time. And that's our video that we tape. I usually tape them here at about 6 or 6:30. So again, guys, we don't want to call you. We don't want to talk to you. We don't want to sell you crop insurance or brokerage. We just want to send you content. Check that deal out this morning.
U.S. soybean conditions experienced a substantial decline last week, with 65% of the crop rated good to excellent, down from 69% the previous week, yet still above the 5-year average of 60%. Last week's rating marked the lowest good to excellent rating for the soybean crop this year. The USDA estimates that 11% of the crop is dropping leaves versus 4% a year ago and 10% on average. U.S. corn conditions also declined last week, with 69% of the crop rated good to excellent nationally, compared to 71% the prior week and 59% on average. Despite the decline, the rating was still the second highest for the week in the past 10 years, trailing only 2016. USDA estimates that 15% of the crop is mature nationally versus 7% last week and 14% on average.
So soybean ratings fell 4%. The trade was only looking, I believe, for a 1% decline. This is absolutely noteworthy, and I could see this persisting because it's been so dry in so many areas. Ratings fell almost universally in the Eastern Corn Belt, and I think that's because August was so dry. We talked yesterday about how a lot of those areas, Ohio in particular, but a lot of Indiana, Southern Illinois, were the driest in August, on record, essentially, in the modern era, essentially. Corn ratings holding together a little bit better. Keep this in mind. It is totally normal to see ratings back off a little bit as harvest approaches, because crop ratings are a view from the road, and the crop just doesn't look as good from the road as it matures, So that's kind of the deal. But the corn ratings would still imply, and the ratings are not everything, I understand, but the corn ratings would still imply a very strong yield, probably a record national yield, probably something north of 180. Soybean ratings are, I don't know, get another week down and people are going to start to get concerned, I think.
President Trump will request an expedited Supreme Court ruling on tariffs as early as today. The request follows a federal appeals court decision that deemed many of his tariffs illegally imposed. In a 7-4 ruling, the court found that Trump exceeded his authority by invoking emergency powers under the International Emergency Economic Powers Act to impose broad tariffs. The court, however, is allowing the tariffs to remain in place while the case continues. Trump argues that the tariffs are critical for U.S. economic strength and claims that overturning them would devastate the country and cost trillions of dollars. Even if the ruling stands, Trump could still impose narrower tariffs through other legal avenues.
I don't have much to say about this. We just wanted to give you guys an update. We knew that Trump would appeal, and he is, and there will probably be some fresh news here sometime during the next few days.
The outlook for Russian wheat exports has increased. Consulting firm Sovcon raised its projection for this season's exports to 43.7 million metric tons, up from the prior estimate of 43.3. The upward revision was attributed to expectations of improved yields. Similarly, ICAR increased its forecast last week to 43 million metric tons. The USDA projects Russia will be the largest global wheat exporter this season, accounting for nearly 22% of all global shipments.
So the wheat market sucks, and I'd like to talk to you guys for a moment about why the wheat market sucks. Let's look at ending stocks to use ratio, and I want to compare wheat and corn. So these are USDA projections. USDA projects that at the end of the marketing year, there will be 43 bushels of wheat left over for every 100 that we used during the marketing year. That's a very, very high number. 43 bushels left over for every 100 that we used. When you look at corn, that same number is 13, and it was as low as 8 last year. So the wheat situation is incredibly burdensome. We've got more wheat than we know what to do with. The wheat market, the futures market, you could argue has been broken for a long time. One of my subscribers commented a couple weeks ago. He said, Joe, did you know that the fund position, the net fund short in the SRW wheat market is larger than the size of the entire US SRW wheat crop? I said, yeah, the market's broken. And it has been for a long time. I've never been able to make heads or tails of the wheat market. I mean, sometimes you can understand it, like, okay, Russia invades Ukraine, wheat spikes. Yeah, I get that. But in a lot of situations, it doesn't make any sense. Because look at it, the stocks, I mean, we're always burdensome compared to corn or soybeans. It's just a matter of how burdensome we are in the United States. We don't have the export demand. It's just not a crop that people are going to be interested in planting a whole lot of in the years ahead, I think.
U.S. corn shipments were near the upper end of pre-report expectations for the second straight week last week. USDA reported that 55 million bushels of corn were inspected for export during the week ending August 26th. The print was up 5.1% compared to the previous week and up a whopping 46% versus the same week last year. Soybean shipments were also near the upper end of expectations at 17 million bushels. The print was up 20% compared to the prior week, but down 6% versus the same week last year. Wheat shipments were strong, surpassing expectations at 29 million bushels. The print was down 21% versus the previous week, but up 33% compared to the same week last year.
Okay, very quickly, corn shipments were great. Wheat shipments were great. As we move forward here and as we get into harvest and post-harvest in the United States, the soybean shipment number is going to be very interesting because we have very few soybean export sales on the books. Our typical prime window for shipping soybeans out of the United States is immediately post-harvest, October, November, December, a little bit into January, and then Brazil takes over. So it's going to be interesting. We need to sell more beans on the export market. It's a huge problem. I think that the market yesterday, beans were down. I think it was a demand focused issue. There were some headlines out of China and how China is going to buy more meal from Argentina and other places. But I think that this lack of export sales on the book is problematic, and the soybean shipment number is really going to start to be a big issue if we don't see those sales, because we haven't sold them, we can't ship them, and we're going to need to ship them here, in a couple months. What did cattle do yesterday?
Cattle futures were mixed. Live cattle were 90 cents lower to 37 cents higher. Feeders were 77 cents lower to 267 higher. Box beef prices were lower. Choice was $1.99 lower at 413.42, and select was 383 lower at 386.17.
Outside market's pretty quiet. Stock market's about flat in the Dow. The S&P's up 30 points. Treasury's off just a little bit. U.S. dollar is about flat. Crude oil is down $1.36 in the October WTI at 64.23. Have a great day, guys. We'll be back on Thursday.